A record close for the S&P 500 and another one for the TSX. Let's talk about the start of 2026 with Keith Buchanan, Senior Portfolio Manager, Globalt Investments. Keith, thanks for joining us today.
Thanks for having me.
Okay, let's start with the jobs data out in the U.S. 50,000 jobs created, but slow growth, and then downward revisions for October and November of 76,000. What's your read on this data?
Well, it plays into a thesis that we've been building over the past year or so, coming into the end of 2025, and expecting soft landing to not look like the market was expecting. We just didn't look at it as a Goldilocks scenario. We looked at it as a scenario where there are more dispersed outcomes, expected outcomes of economic data, of Fed policy, and that would, really, convolute some of the expectations for the marketplace in a way that could make the recent 2 years run of growth kind of expanding valuation, and that's following through with earnings growth, to make it a little more complicated and a little more selective. And that's what we've seen, in our opinions, over the past 2 months. And it's really started 2026 in a similar manner. And that this data point this morning really fits that mold, and that some of the volatility around what this low hire, low fire market really means on a month-to-month basis, but also what it means to the broader macroeconomic story as well.
Okay, so what else will feed into the volatility, do you think, this year?
Sure. Monetary policy coming to neutral. We've had conversations from Fed speakers that talked about us being very, very close to the ballpark of neutral. And as we come to that, we'll see a dispersion, as we've already seen in the last couple of meetings, of opinions of some of the policymakers, and some of the conversations that are more publicly facing will have more diversity of thought. That can lead to some confusion, but definitely not a consensus that is narrow as it has been in the past couple of years, and pointing in one direction for monetary policy, which has been moving south towards neutral up until this point over the last 2 years. So as monetary policy starts to coalesce around this natural rate of inflation and natural monetary policy level of interest rates, we're really looking at what does the market look at next. Monetary policy moving south is a very clear picture for investing, but now investors have to be more selective, and we feel like that will follow fundamentals more so over the next coming quarters, more than it has in the past couple of years.
Okay, so because, as you mentioned, you heard the indication from the Federal Reserve that they are where they are, sort of for being neutral, what is your expected path for the Federal Reserve this year?
We're looking at 2 cuts, probably as we have a little more personnel change at the Federal Reserve. But over the course of the next 8 meetings, we see two cuts max. We felt like the risk to that is to the downside, though. And I think that's where the market and our shop differs in some way, form, or fashion, is that if we do end up with 0 and 1 cuts, what does that mean for the marketplace? It typically means that either inflation has become a little more stubborn than the market thought, or the jobs picture clears up to the extent of maybe mid-year to the later part of this year. We haven't seen a lot of that data come through just yet, and so we feel like there's a risk there that we can see that change and really surprise the marketplace. And that's what we feel like is probably the case that would lead stocks to have a little more volatility, and frankly, a little more of the value to growth to value, large to small, that we've seen over the last couple of months. We feel like that's been indicating a change in monetary policy, and we still see those changes taking place on a month-to-month basis.
Okay, let's talk about the start of the year in a wider sense. The S&P hitting a record high today. What sectors are you seeing money flow into? Is it a continuation of what we saw at the end of last year, where tech is kind of stalled and people are looking at everything and almost anything else?
Absolutely. We've seen value outperform growth from a Russell 1000 standpoint over 300 basis points. Small has outperformed large by a vaster extent, and just over the first few trading days of this year. So this is a very narrow and small sample set. But if the first part of January is any sign for momentum, it's definitely to the backs of the value, international, small cap names and sectors and industries that have been shunned, at least from a valuation standpoint, and not kept up with the large cap growth space over the last couple of years. So we see that continuing. I feel like that plays again into the macroeconomic picture that we've been setting up for over the past year and a half.
Okay, so what would you say investors are looking for? Are they looking for something less volatile? Or are they looking sort of to tried and true, or they can park their money, make a little bit of dividend? What are they looking for right now?
They're looking for things that make sense from a macro standpoint and also from a fundamental standpoint. So they're looking for cash flow generation that's better than the market median, if you will. Valuations that aren't top of the highest growth, names in the SP 500. So reasonable valuations. Looking at market cap outside of the biggest 12 names in the SP 500 as well. And we're seeing those names start to perk up in ways that aren't necessarily justified by huge momentum shifts in their fundamentals. Those stories haven't completely changed, but some of the charts and some of the pricing and volume has changed in a material way. So we feel like that attention is leaking outside of what's really carried today over the last 3 years. And we're excited about some of that breadth that the market is showing coming into 2026 and the start of this year as well.
Do you think there could be a bit of a turnaround with that? Because this has lasted now a few months, people moving away from tech, as you say, valuation concerns. But we definitely have seen that some of these companies have sort of what it takes for more growth. They're not sort of, as we talked about many, many years ago with the internet boom, sort of speaking about with nothing backing them. They have some backing. So do you think we could see a turnaround in a push back to tech stock later in the year?
Absolutely. Look, I can't take away the cash flow generation and earnings growth that's very, very real, and all of that AI-related names, also those adjacent to that story. The fundamental growth has been backed up. I mean, the sentiment has been backed up by fundamental earnings growth and cash flow that is very, very real and material. And we don't feel like that's going to fall apart anytime soon. We just feel like there's more growth with a wider spread, 3 to 3.5%. Economic growth that we see coming out of fourth quarter, as that continues, hopefully in the first quarter, we haven't really seen a lot of deterioration on the momentum side there. That spreads out to spaces outside of the AI infrastructure build out that is very real and is tremendous, windfall for those shareholders. We feel like there's a lot more economic generation outside of those spaces. We want to make sure that we're there in order to take advantage of a valuation gap that has grown persistently wide over the last several years. And that catch-up trade could be very, very volatile and also, very beneficial to those shareholders.
All right, Keith, I got to leave it there, sir. Thanks for joining us. Keith Buchanan is with Globalt Investments.